Jones.
Here.
Richard Costigan.
Here.
Margaret Brown. Good morning. Good morning. John Chung, represented by Frank Moore.
Here.
Rob Fechner. Dana Hollinger.
Here.
Adria Jenkins Jones.
Here.
Priya Mather.
Good morning.
Good morning. David Miller.
Here.
Ramon Rubalcava.
Here.
Bill Slayton. Teresa Taylor. Betty Yee.
Okay, thank you very much. And the next item is approval of the Investment Committee timed agenda. This is moved by Ms. Taylor.
Second.
Second by Ms. Martha. Thank you. Before I call on the chief exec, chief.
We need to take the
Take a vote. All those in favor, aye. Aye. Opposed? Hearing none, the item passes. Thank you. Before I call on the CIO, I would just like to make a couple comments. As some of you may have seen, we officially announced our new Chief Investment Officer today, Ben Main. Ben is a familiar face to CalPERS. He worked for us for 7 years before leaving to become the Deputy CIO at the State Administration of Foreign Exchange, or SAFE, in China. We are excited to have him back. Ben has a strong investment background and a deep understanding of our system and our investment operations. We look forward to introducing him personally to our members, employers, stakeholders in the future when he returns to the United States. So with that, I'll call on the current CIO, Mr. Eliopoulos.
Terrific. Good morning, Mr. Chair, members of the Investment Committee. I'll just say I'm just delighted for CalPERS. What an incredible selection. What an incredible leadership team with Ben Ming and Elizabeth Borky and the rest of the senior investment staff. It's quite remarkable, the level of talent that resides here already and is being added. And I'm just thrilled. That wasn't my prepared remarks, but having heard that announcement this morning, I'm really happy for CalPERS. We have a full agenda today before you. September kicks off the time for a deep dive into the individual program areas for review of their annual performance for the year and looking for highlights into the coming fiscal year. Today we have our annual review of our global fixed income program and our real assets program. These are our two principal diversifying assets to our global equity exposure. They're also the asset classes that provide the highest component of return to us through income and cash yield. Very important parts of the overall program and important for the committee to understand their role and how they go about structuring their portfolio and their organization. In addition to that, we have an action item with respect to the annual California Public Divest from Iran and Sudan Act, which you'll be hearing from, as well as some important information items, including a update from our Global Equity Corporate Governance Unit on the component of their work on proxy voting, share owner campaigns, and corporate engagement, and more to come from me and the team on that when we get to that agenda item. The other point I wanted to emphasize today, thinking about the fall and getting back to school, as you might recall last year, we had our Sacramento Mayor, Darrell Steinberg, here to talk about the Sacramento 1,000 Strong program that the mayor launched last year with the goal of bringing together school districts, community-based organizations, state and local funding partners, students, and businesses to provide year-round paid internships for local youth while fostering a highly trained and diversified workforce for Sacramento businesses. This program, in addition to coordinating intern placement, 1,000 Strong also provides students with 40 hours of workplace training in preparation for their internship tenure. This program has personally been an important one for me and for the entire investment office. It's been a very positive experience for the investment office to be part of this program this past year. Our investment managers took the time to expose the interns to investments and to learn about investments as a potential career. We looked at this as an opportunity to mentor students and give back to the Sacramento community with an eye on our own selfish desires to attract these students back to the investment office at some point in their future career. When the students arrived last year, most were quiet. Some, and actually almost all, had never been in an office before, which was a particularly poignant and important point for me, because I remember my own career being their age and have never been in an office building before either. And the opportunity to expose these young adults with so much potential and so much talent to this opportunity is incredibly important for their lives, but more importantly, it infuses our investment office with talent and optimism and an infusion of energy for the future. Over time, these students have learned to do seasonal clerk work. They've learned the expectations of being in an office environment. They've watched how work gets done, sometimes with amazement, sometimes with the learning that comes with actually being part of an organization. In addition to that, each of our interns got through the difficulties of the first year of college and balancing, that important first year in school with having a job. After this first year, we thought they would graduate from the program and move on. Instead, we are very fortunate to have 2 of the students stay with us in the program this year, and the other 2 students were hired as seasonal clerks to work part-time in the office as they pursue their degrees. All 4 of these 1,000 Strong interns and graduates are in class today, as we'd want them to be in school. So they're not able to be here in the auditorium to be recognized. But they are very much part of our team and continue to contribute to the investment office and will continue to contribute to the investment office. I am very proud to reintroduce and name them to the board for your recollection. So coming this year, we have Kendo Turner will be back with us. He is currently enrolled at American River College. We have Yang Zong, who is currently enrolled at Sacramento City College, will be back with us as an intern. In addition, we have Anna Razzo and Abrina Lamar. Both will be seasonal clerks, and both are enrolled at California State University, Sacramento. In addition to that, I'd now like to welcome our 2 newest interns, who we are just absolutely, our new 1,000 Strong interns, and we're absolutely thrilled to have them with us today. I'd ask if you could just stand up for a minute. They're super nervous, but I told them they don't need to be nervous at all. We have Andrea Torres, who graduated from Sacramento Charter High School and is currently taking online classes part-time at Liberty University in pursuit of a behavioral science bachelor degree. Andrea is bilingual and fluent in both English and Spanish. Thank you for being here. In addition, we have Alyssa Hampton, Melissa graduated from Sacramento Learning Tree Academy in June 2014 and is pursuing her associate degree in childhood education. So thank you for being here. We're thrilled to have you. And with that, Mr. Chair and members of the committee, I'm thrilled to start the day on a very uplifting and hopeful note.
Okay, thank you for your report. We now move to action consent item, approval of the August 13, 2018 Investment Committee meeting minutes. Moved by Mrs. Hollinger, second by Mrs. Mather. All those in favor? Aye. Opposed? Seeing none, the item passes. Thank you. We have information consent items next on the agenda, but I have received no request to remove anything from that item, so we will go to the next item, which is item 6. California Public Divest from Iran Act and Sudan Act.
Right, thank you and good morning.
Good morning.
Agenda item 6A is part of the annual review process mandated by the California Public Divest from Iran and the Sudan Act. As this committee is aware, these acts prohibit the boards of both CalPERS and CalSTRS from investing in companies with specified business activities in Iran and Sudan, subject to the fiduciary duties of the board. The acts require identification of and engagement with companies identified as potentially subject to the acts and submission of an annual report to the California legislature. The CalPERS annual report to the legislature is scheduled to come before this committee later this year in December. For our report to the legislature, CalPERS groups companies related to the act into 3 categories: divested restricted, under review, and monitoring. Divested restricted companies have been determined to meet the threshold criteria for divestment under the Act, and this committee has concluded that divestment is consistent with its fiduciary duties. The under review list is comprised of those companies that are undergoing the engagement and communication cycle as specified in the Acts, and the monitoring category is comprised of companies that do not yet meet the threshold for divestment, the threshold criteria specified in the Act, but that we nonetheless want to continue to monitor for possible changes in status that are relevant to the Act. From time to time, companies are recommended for removal from the review category where staff's engagement or possibly just research activities have led to the conclusion that the companies are no longer subject to the Act. And today's item is of that nature. Specifically, staff is recommending that the committee take action to remove the 12 specified companies from further consideration under the Acts. Additional information as to key findings for each company is provided in the item. So with that, I'll pause and ask if there are any questions.
I see no questions, but I do have one comment. Our divestment policy is to bring a report every 5 years, and I know Mr. Costick and I have spoken with Mr. Eliopoulos about whether or not we can combine these reports into one, and I understand you're looking into that because it may require a lot of additional work to bring them all at one time.
That's correct, Mr. Chair. The committee directed us and allowed us to bring the 5-year review for Iran, Sudan 2 years from now, and we're looking to see whether we can bring all the 5-year reviews at that same time in a way that is efficient for the investment committee and not overwhelming.
Okay, thank you very much. Okay, this is an action item. Oh, Mr. Moore.
Thank you. Sorry about that. Most of these organizations are cut and dry, not subject to the divestment acts, but there are 2 companies, Dubai Islamic and ENGIE, that looks like it's subjective whether or not they're subject. Can you describe why you think they're not?
They gave us a very good response to our inquiries that was persuasive to staff.
Well, for instance, ENGIE, so looks like they have some investments in Sudan that are related to the requirements in the Act. Do you not disagree?
I'd be happy to go back and explore that further. That was not the conclusion we reached, but we will definitely go take a closer
Okay,
look.
thank you.
Thank you.
Okay, thank you. Seeing no further questions, as I said, that this is an action item.
I'll move it.
Moved by Mr. Costigan. Second by Ms. Hollinger. All those in favor?
Aye.
Opposed? Hearing none, the item passes. The next agenda item 7, informational agenda items. The first one is Global Fixed Income Annual Program Review. Mr. Phillips. And these reviews on an annual basis, Mr. Eliopoulos, we alternate who will do a deep dive on these type of reviews, like 1 year staff, the next year it's the board consultants. Is that correct?
Not quite. So we do alternate when we do the total fund report. We alternate who goes first,
Okay.
whether the staff or the consultant goes first.
Okay.
For the annual program reviews of each asset class, we have not alternated. We have the staff go first and then the consultant, each who's done a deep dive. So
Okay.
for this presentation, first you'll hear from our staff and you have the ability to talk with our staff. And then secondly, Wilshire, who's the board's investment consultant, has done a deep dive and will give you give those conclusions.
Okay, thank you.
Yep.
Good morning. I thought I'd be formal since some of you might be wondering where Curtis is at. My name's Arnie Phillips. I'm the interim managing investment director for Global Fixed Income. To my left, I have Lou Zahorik, who's an investment director and heads up our global corporate credit team. And I do want to give a thanks to Lou. I think when Curtis was up here, I think there's always the perception that they're the be-all and do-all. And the reality is in my role right now, I'm just the nameplate for a great staff, and Lou has been extremely helpful in this transition, and I appreciate it. And we're fortunate to have somebody of his character and knowledge here in addition to myself. So the protocol today, I'll get it started. I'll talk about the performance. I'll talk about the role of fixed income. I'll hand it over to Lou to talk about accomplishments for the past year, what we're working on in the current year. We'll pause at that point for any questions you may have, and then following that, Wilshire will jump in. This is, I joked about Curtis, but this is the first time in a long, long time that somebody's been, other than Curtis, up here giving this presentation. And the reality is a lot of what we will talk about today is actually during Curtis's time and should be reflected of the great work he did. I have worked for Curtis for 25 years, and I think I have a pretty good read of his strengths and weaknesses, but more importantly, his accomplishments. I think two of his greatest legacies are something that Ted mentioned at Curtis's last board meeting when he talked about Curtis just being laser focused on returns. And I do think that was Curtis's focus. And I think when we get to the performance, you'll see why Curtis cared and why it was very productive. But I think more importantly going forward, what I view as one of Curtis's greatest legacies is what he left behind, which is a great staff of fixed income professionals that will continue what he built at this point. Speaking of staff, last board meeting, John Rothfield from the fixed income staff was up here doing his semi-annual economic update. At the end, I saw and heard the admiration that many of you had for John's work. And I think it's important to recognize that we have a whole staff of John Rothfields doing similar work. They may not have the Australian accent that John has, but they're all doing similar high-quality work in the mortgage market, in the credit market, international investments, and global governments. And I do think that speaks highly to Curtis's legacy and the team that he built. And it's important. We manage 93% of the fixed income assets internally. So having a good staff is paramount. Turning to page 2, which I guess there we go. Reviewing the performance side here. Last month, when we were looking at total fund performance, we briefly touched on fixed income performance. And I think it's important to view it in two different ways. There's the absolute returns, just the pure return we get, and then there's the excess return we get, or the amount we earned over what the index returned. And starting, so the top box up there, the top little matrix, the bottom line that says excess return, you can see that over any of the periods you pick there, including back to inception, which is 1988, we've generated positive return. If you look at just the 5-year number to put that into context, Eric Bageson last month at his presentation talked about a basis point on total fund equaling about $35 million. Well, we don't have all the assets, but we have a good chunk of them. And if you look at our 5-year return, take the average balances during those 5 years, take the alpha or excess return that was generated in those years, it comes out to about $1.9 billion of incremental value over if we just indexed. And given our employees are somewhere in the 40 to 50 in fixed income, it's somewhere around 40 to 45 million per employee for that 5-year period. So I think, again, focusing on Curtis on returns matter. I think when you put it in dollars, it sort of jumps out how much we are able to add and how important it is. But that's the excess return side. When you look at the absolute return numbers, it's more evident that our job is challenging going forward, and actually has been challenging over the prior years. If you look starting at the right of the chart since inception and move to the left, the numbers just keep getting smaller and smaller. And in simple terms, we get our returns from two places. We get a coupon on our portfolio, and we get a price change on that portfolio. And following the global financial crisis, global central banks around the world went to a more easy monetary policy, which equaled for us lower interest rates. Those lower interest rates are the coupon portion that we get. But now those same central banks are starting to unwind, slowly, but starting to unwind that easy monetary policy, and interest rates are rising. In the fixed income world, higher interest rates mean lower prices. And what you have seen in the last year, but actually is the last 2 years, while we've eked out a slight positive return, for all intents and purposes, it's been close to nothing. And that is, I think, largely the effect of the global financial crisis taking rates low and now starting to unwind those to where price performance is offsetting the coupon we're receiving annually. The other interesting thing is when you look at the capital market assumptions that go into our asset liability process, we made the assumption at the last asset liability process that income would generate 3.5%. If you look at our 3-year number, we're more like 3.2%, the index more like 2.7%. The declining interest rate environment we've been in, which really started in the early 1980s, has flattened out, and a lot of people would argue is in the process of maybe going the other direction. So I think the expectation for fixed income in coming years is it's going to be a challenging environment for us from an absolute return basis. Mark Anson, a former chief investment officer, was sort of famous for his top 10 lists. And at Curtis's going away party, he sent in a top 10 list. And one of the 10 reasons he quoted Curtis as leaving were, for the first time in Curtis's career, interest rates were actually going up. And I think it was funny, it was a joke, but it had a hint of truth to it, to the extent that I think that is the environment that we are going to be challenged with in coming years. But that, I think, focuses on what's the role of fixed income. And Ted had mentioned earlier, it's to provide a source of income and be a shock absorber for equities. Part of our shock absorber mechanism is we have 40% of our portfolio in longer maturity U.S. Treasury securities. The longer maturity means they also have higher interest rate risk. And they're really a form of insurance for the total fund. And I like to think of it using a personal finance example. Oftentimes when people buy insurance, whether it's home insurance or auto insurance, it always seems expensive and something you'd rather not pay for until you actually need it. And your son or daughter takes your new Lexus out, wrecks it, first thing you make sure they're okay. Then you call your insurance agent and you're really happy you have insurance at that point. As it relates to CalPERS, I would say global equity is the Lexus, global fixed income is the insurance policy. And it is important because having that profile in a rising rate environment is going to make absolute returns in fixed income a challenge. Switching to the inflation portfolio, which is the second box up there. Again, we've had solid 5-year returns, but what's really, I think, challenging for the investment office and something that we are talking a lot about and have a roadmap initiative looking at is when you look at the mandate for fixed income, or for the inflation portfolio, it is to provide protection against inflation. And yet, if you use something like the Consumer Price Index or CPI, you look back the last 3 year, the 5 year, the last 10-year period, CPI has been averaging somewhere in the neighborhood of 1.4 to 1.7%. But if you look at our inflation index, which is the middle column there where it says policy index, we're not getting anywhere near 1.4 to 1.7% out of our inflation index. Now, our staff's outperforming it, but we're outperforming in an index that doesn't seem to be accomplishing what we need to get out of it. And so the capital market assumption there was we were going to get 3%. If you look at the 3-year return, it's 0.8%. If you look at the index, it's even lower at 0.5%. So we have, as I mentioned, a roadmap initiative to look at possibly doing something better in the inflation program that better matches what we need going forward for inflation protection. And then finally, moving to the liquidity portion. The liquidity, we care about the returns there, but they're really secondary to, as the name says, provide liquidity for the fund if we need it elsewhere. But it's really about capital preservation and just making sure the money is there when we need it at some future point. And so while we've had decent returns there, it's just sort of icing on the cake. That's not the main purpose for those assets. I think at this point, I'll hand it over to Lou to talk about some of the accomplishments, one of them specifically to the liquidity bucket there, and then Lou will talk about what we're working on in the current year, and then at that point, I think we'll stop and answer any questions you may have.
Lou Zahorik, Investment Director, Global Fixed Income. I'd like to highlight on page 4 of 43 a key total fund accomplishment that Global Fixed Income implemented this last fiscal year was the rollout of the internally managed CalPERS Short-Term Investment Fund, or as what we internally call it, the CalPERS STIF Fund. At last year's fixed income review, Todd Smith discussed this project and his development of this fund. The genesis of this project was identified before and after the global financial crisis. At that time, senior staff at CalPERS determined that we needed to have a more efficient and more conscious way to have risk in our most liquid portfolios. By bringing the management of this fund internally, we are better positioned to control that risk and the characteristics of that liquidity pool, and ultimately to be able to access that pool, that liquidity pool, in the most extreme financial stress periods. That's one of the most important factors why we decided to bring in-house. As I said, Todd Smith in fixed income led that development, but I would have to say we could not have accomplished this implementation without the help of Matt Flynn and his team in the investment servicing group, and without the collaboration and flexibility of State Street Bank to help modify our custody and cash management processes so we could sweep funds from our external managers into our internal STIF fund. And honestly, I'd like to acknowledge our internal credit trading staff and the execution services strategies group that work on the day-to-day trading and portfolio construction of this portfolio. The portfolio has grown in size from about $8 billion prior to this strategy being developed to this past year. We've managed anywhere from $25 to $35 billion internally now. Through these efforts, we've calculated we're saving anywhere between $3.5 million to $7 million. So it's a big win for us internally. For the current fiscal year, Global Fixed Income is continuing to help the investment office develop skills and capabilities as it relates to total fund returns. In the prior years, Global Fixed Income has made extensive contributions in developing ESG efforts and incorporating those in our investment process internally and with our external managers. This year, we have committed 2 employees to spend 10 to 20% of their time working with Beth Rickman's Sustainable Investments team, specifically on research. In addition, we have 4 credit research staff members working on specific research groups focused on water issues and disruptive technologies. Finally, Arnie and our entire team are focused on working with the trust level portfolio management and the opportunistic strategies group to develop the total fund liquidity and leverage capabilities in the future. We'll stop there and see if there's any questions.
Yes, we have one, Mr. Moore.
Can you go back to page 2 of 43 again, where you have your returns by sub-asset class? The inflation asset class did great for the last 1-year period, but inflation was only up 2.7% for the last year. What accounts for the premium or the difference on that yield?
It's completely driven by the commodity side and specifically the oil side of it. Oil's had a very nice run this year.
Thank you. Appreciate that.
Ms. Mather?
Yeah, thank you. I think it's quite something that we have, that we manage so much of our fixed income portfolio internally. I mean, 93% is the number that you shared, and it's extraordinary that we've been able to develop such a high caliber, truly talented team internally. And I really appreciated your opening comments, Arnie, about Curtis's leadership, and I think that has been important. But really, the fact that the team has works together and across and increasingly across the entire portfolio, the entire investment office to really drive value, I think is so important. I mean, the credit side, understanding credits is essential not just to fixed income, but of course to global equity and to other asset classes as well. So I really appreciate that that increased commitment to sort of that enterprise-wide focus. I noted, I think you were very clear about sharing your concerns sort of moving forward around absolute return and how's this asset class going to perform moving forward. And of course, it is an important component of the portfolio, even in times when it's not performing well, because as you say, it's a shock absorber. But how, and I don't want to, obviously I don't want to get too much into detailed strategy, but how are we positioning the portfolio? How are we looking at it differently moving forward, given that we are in a rising interest rate environment, and that's expected for some time to come? Are we doing anything differently?
Well, everything we do daily is dynamic. It's what I like about the job. What I knew yesterday helps me today, but isn't going to do my job today. I have to keep learning. The interest rate exposure is, in a lot of ways, a given. We have never, at least in the 25 years that I've been here, been big proponents that we have the skill, or necessarily anybody has the skill, to necessarily predict interest rates. Mm-hmm. So I don't think you'll see us deviate a whole lot from the index as it relates to interest rate risk. I know I don't know what the exact 5-7 years ago, there was talk about shortening our interest rate exposure by changing our index based on what seemed reasonable at the time that rates were going to go up, and yet here we are however many years later, and nothing's changed, and would have cost us a lot of money had we done that. So I don't think you'll see us, that we don't view that as, even it's a tool in our toolbox, not one that we feel we're necessarily very good at, nor really anybody is. But within the portfolio, we certainly can position for different interest rate environments and how they impact the economy. And I think we view it as sort of late cycle right now. Certainly the tax policy in the last year has given us a little bit more runway. But I would say, given where things are trading, we're a lot closer to home at the moment, keeping powder dry for potential opportunities down the road. Within asset classes, I know Lou has a sort of a defensive tilt in his, higher quality tilt in his corporate portfolio. Within the mortgage portfolio, we can position for higher interest rates and what that might mean for specific parts of that product. So we'll continue to manage within our asset classes. I think you'll find tilts across asset classes we're probably leaning towards doing when it's more obvious in the past. And a lot of that, not that it didn't necessarily work in the past, is we have a lot of total fund responsibilities now, and we want to make sure that I think it's investment belief 7, that we're being compensated for the risk. And I think you'll see, when we have broad consensus among our senior staff that something is attractive, we will continue to make those bets like we always have, but probably not when it kind of seems cheap. You'll probably find we try to make money within our specific subsectors and not cross over nearly as much. But certainly, higher interest rates have implications throughout the economy, and we will try to get those into our portfolio to still take advantage of it.
Thank you. And I know in fixed income we have less exposure to international credits than we do in our global equity portfolio. Can you just share a little bit about how thinking is evolving in that regard and what our current exposure is?
So our index has approximately 10% to the international area, split between developed markets and emerging markets. And what we have found is that the vast majority of the return comes from the foreign exchange exposure and much less from the actual bond aspects of it. And the dollar has been extremely strong, and so we've been underweight international, and that has worked. But again, we think the dollar rises sort of late stage also. We don't necessarily think it's going to turn tomorrow, but maybe closer to the end than not. So we are starting to close some of that underweight. But it's a relatively low yielding part of the world. In a lot of areas, the international markets have had negative returns or negative interest rates in recent years. And so optically, and when we run scenarios, they often don't kind of pencil out as extremely attractive because they're so low yielding. So we've had a natural kind of underweight, but given the dollar positioning, we're getting more neutral, but I would be surprised if we got to an overweight anytime soon.
Okay, thank you so much.
Yeah, thank you, Ernie. Ernie, you made a comment that triggered a memory about 5-6 years ago at the investment committee, where we had this, I don't know, maybe 2 or 3 different meetings about duration with the interest rate risk. And what triggered my memory is you said we would have lost a lot of money if we had adopted that change. And so I think it's probably intuitive that periodically, when we have these lengthy debates on policy, and then we go out 4 or 5 years and come back and say, well, what would have happened? So it helped us be informed on our decision making as we go forward. So thanks for holding the ground on that decision. Okay, Mrs. Taylor?
Yes, thank you. Arnie, I wanted to thank you for your presentation. Getting in front of the board is never fun or easy, I don't think. But also the fact that you gave credit to Curtis, but your team, and that this is such a team effort, as my colleague Ms. Mather said, I really appreciate that you acknowledged all of that. And I think you guys are doing a great job. I did have a couple of questions, and I think you kind of answered the one question I had, which was you had mentioned that you were looking at, let me make sure I can find my notes here, possibly doing something else to change the returns because they were becoming lower because of the rising interest rates. You sort of talked about that. Could you expand?
Sure. So on the income portion, we will only be changing within our portfolio, trying to position, but won't be taking interest rate tilt in our portfolio per se.
Okay.
Where we will be hopefully re-looking at and potentially doing something different is in the inflation component, simply because the index we're targeting is not returning anything near what actual inflation's running. And so if our goal is to protect ourselves to inflation, it doesn't appear our index is necessarily going to do that. And so
Okay.
that is something we have a INVO-wide process working on to reevaluate that and decide if something should change, and if so, what should it look like.
Okay, great. Thank you. I'm glad I asked because I didn't quite understand that. And then I also wanted to thank you for making sure that you're integrating our ESG policy. The 10, was it 2 to 3 people? Is that what it was?
There's two individuals specifically. One's contributing 10%, the other one's contributing 20%. So it's in that range.
Oh, wow. Okay.
Yeah.
And I really appreciate you guys looking into that and working on that with Beth's office. So thank you very much.
One other thought, it was interesting when the water topic came up, we literally had like half the staff wanting to work with it because it's a
huge issue, especially in California.
Yeah,
right?
exactly. And so we ended up with a couple people, but I know Beth, even outside of fixed income, had a lot of people willing to help out on what's a very interesting topic.
Great. Thank you very much.
Ms. Yee?
I was just going to ask you about the water topic, but just generally, and I know it's obviously here in California top of mind for everyone, but what opportunities at this early stage have you identified with regard to water or other disruptive technologies that look promising?
Well, I'll take the first shot at it. Lou might have some thoughts too. My day job when I'm not filling in for Curtis's retirement is the mortgage portfolio. And we've been thinking quite a bit about availability of water and what it means for housing. And you can pick your warm climate, desert condition, U.S. places and kind of wonder long-term, will they have a water issue going forward if we see climate change? And so we've been thinking about it from that standpoint. I think the most fascinating presentation that I've seen in my time here at CalPERS was about climate change and just immigration patterns that come out of, you can identify the obvious areas that, or somewhat obvious areas that will feel the initial brunt of climate, but what's really interesting is when you see the migrations from those areas and what it might mean for other areas. And so it's sort of like demographics in a way that it's interesting. It's not always easy to put the tilt into your portfolio because it's sort of slow and glacier in its pace, but it is definitely something that we do think about for specific investments, if not just the whole portfolio.
Okay.
Paul, do you want to comment? Paul Kramer from our investment staff is one of the folks that works most close with Beth Rickman's sustainable investments team and has done a lot of work in this area.
Hi, good afternoon, ladies and gentlemen. Yeah, so I work on that research project with sustainable investments. I guess I would say initially, I don't want to make too many definitive comments about that because we're really kind of early in the research process. I would say that right now we're very focused on trying to define water risk from an investment perspective. We're looking at ways to screen the portfolio for water risk across the fund, which kind of has, different implications depending on the asset class. So that's sort of a nuance we're exploring. And I think the last piece, which is maybe what you were getting to, was what investment opportunities might come out of that. So that's kind of the steps we're following right now. And I think I would probably wait to talk about, observations or conclusions, to a later time.
Yeah, that's great, and really appreciate you looking beyond just this asset class with respect to your review. Thank you.
Okay, thank you. Does that conclude staff's part of this presentation?
Yes, I would just add one thing for the committee's attention is page 40 of the attachment. I don't know whether we can shift to it quickly. I don't have the clicker in front of me, but there we go. Because we often get asked, this topic of ESG integration, is it all politics? Is it fluff? Is it pressure on the investment staff? And it's hard sometimes to give some specific examples. And I think you can appreciate with our global fixed income team, the men and women of our fixed income team are active traders and investment professionals in the markets all the time, and really their stock and trade is security analysis and risk management. And so when we've talked about ESG integration over time with all of our asset classes, but particularly our fixed income group, they look at it from perspective of what does it mean to be a great investor, and how do we analyze our positions for potential risk? Because as Arnie said, we absent price changing during the course, if you hold the security to its maturity, all you get is the income that was promised. So risk awareness, risk mitigation is the principal duty of this great fixed income team that we have. And they really see this ESG integration as part of what they've already been doing for decades, but really focusing on some of these emerging risk factors, water risk being one of them, the controller underscored. But as you look at just 4 examples out of many, what we're trying to do is start to provide the committee with some more specific and tangible areas where anyone in the public that's looked at these 4 topics would say, yes, that's what you want investors to do, and that is what our investment team sees as their core of their investment activity. In reviewing, holding a security with a potential gas company, you'd want them to explore their risk mitigation with respect to pipeline leaks, and really weigh what are, in the pricing of it, what is the reward from the security versus the risk. Now, sometimes they'll be satisfied and say, we like the reward of that gas pipeline company, we're going to take that risk. And other times they're going to say no. The point is, the investment committee and we as investment staff, you want us to be considering these risk factors very specifically as we combine them with other risk factors in the portfolio, principally price and risk. The other example they gave is this energy bond. Our team views it as part of their principal duty to explore what is this company doing in terms of carbon reduction and deleveraging. And then lastly, on the sovereign side, underweighting Turkey sovereign bonds and overweighting Mexican sovereign bonds, looking at what the future will hold in terms of the governance situation in a given country is really the core of an investment professional's duties and risks, so that we really see this as the fabric of how we approach investing. And what we're trying to do in these examples, and we have 43 slides, and we're trying to just highlight 4 or 5. That's our agreement with the investment committee. But this one in particular, I think, is worth reading through and pointing out publicly, because it starts to answer some of the questions in terms of, well, what is this ESG integration mean? Why would you care about it? And I think anyone that knows our fixed income team and knows the investment professionals and the fiber of earning a risk-adjusted return will look at these examples and nod their head and say, yes, okay, this is what we want investment professionals to be doing. So just wanted to underscore that before we had turned it over to the consultant.
Yeah, very good observation. We did have a couple of questions. Ms. G?
Thank you, and thank you, Ted, for that response. I think when any number of us are engaged more globally on these issues, the leadership of CalPERS is not lost. And I think these are just some examples, and I think we could probably come up with a pretty lengthy list of this type of work in each of our asset classes. I wanted to ask you about the slide prior to that, slide 39. This has to do with the carbon footprint comparison of the internal credit portfolio relative to the benchmark. And I was curious about this one because the use and reliance on the MSCI carbon data to complete our work. I guess two questions. One, when do you hope to have the process completed? And I guess more importantly, and I'm excited about the possibility of eventually tying this into some of the leadership role that CalPERS is playing with respect to the Climate Action 100 initiative. Yeah.
Lou Zahorik, Investment Director. If you remember, a year ago at our last fixed income review, we did present to you the carbon footprint analysis for our portfolio. I believe as part of the reporting process, I don't think we're due to present that again for another year.
Okay.
We're just highlighting that we are, in the past, we've used MSCI's carbon data. Paul actually was the investment manager that worked specifically on that project. So that's where that's really at stage.
Okay. All right. There'll be a lot of interest in this, so I just want to be sure that when we are at that point of, having some findings, that I think that could be helpful for others as well.
Mm-hmm. Mr. Rubalcaba?
Thank you. Ted, I just want to thank you for bringing up the ESG. I'm glad you pointed up to those screens. And I was going to bring it up because I was looking at an old issue this summer from a plan sponsor that a brief article on ESG, how everybody's finally catching up, and the U.S. is an outliner behind. But I'm glad that CalPERS with your team has taken a big role, and it gives me confidence for sustainability in the future, because that is one of the principles. We keep seeing in a little literature horizon, this long-term horizon, and that's going to be, I think we will be rewarded for our members, for our beneficiaries. So I thank you for that and for the staff.
Okay, thank you. So now we'll move to 7B, Consultants Review of Global Fixed Income.
Good morning, Tom Tote with Wilshire Associates. I'm going to start my comments with, I think, the key takeaway, and I think this is important, that Wilshire's evaluation and our discussion with staff and our understanding of the portfolio and the process used to build that portfolio has led us to conclude that it continues to be managed in a very effective and risk-conscious way. It leverages the deep expertise of the team. Now, that being said, there is some uncertainty with changes in the MID, which are reflected in our score, and I think that's appropriate, and we'll talk a little bit more about that as we move through the item. As we've talked a bit about so far today, their investment approach is very consistent with the strategic role that fixed income is meant to play in the total portfolio. As staff mentioned, providing income, some stability, and equity diversification is critical as you manage the portfolio through a variety of market cycles. We've talked a lot about the performance, and the numbers speak for themselves. The portfolio has done an outstanding job adding value over and above its benchmarks. I thought it was also important to point out, I won't ask you to move to the chart, which is in the appendix of the memo, but you'll also see that the realized risk of the portfolio over the last couple of years has actually come in below or at the risk of the benchmark. So the portfolio has outperformed over time at the same or less risk than the index. So from a risk-adjusted return perspective, excellent results there as well. If I could have you flip forward to our scoring matrix, which is page 116 of the packet. I never thought I'd have the opportunity to use this term, but I'll use this opportunity to correct some fake news, which we've seen a bit recently in the press. The overall score for our review of the fixed income program is a score of B, which is an outstanding score overall. There are some subcomponents that you might naturally question, why have we derived these scores? And so I wanted to touch on those very specifically. And it starts right there at the top with the organizational score. The organizational score is a component of two things. It's the overall firm, and then it's the team. And where you'll see a more challenged score is in the firm score of a D, and that's the mark that made news, some headlines earlier. And I think that's, when you think about the way we generate these scores and what we're comparing the money management component of CalPERS to, it's other large asset managers in the space, the PIMCOs, Vanguards, Fidelities, Wellingtons, what have you. And as we've talked about for many years, there are challenges that CalPERS as a public entity faces that other private for-profit entities don't face, things like equity ownership, and specifically to the stability of the investment team. We're going through the process of a change in CIO, and if there were a change in CIO at Fidelity or at Wellington or what have you, our level of uncertainty goes up, and I think naturally the score should reflect that, and it does in this case. Our expectation is that going forward, that score is likely to improve as we get the team in place and we see that stability return, and therefore that score should increase as we move forward. Now, on the team side, it's a similar story, although the team score is a bit higher. It's rated as a B. To put that in context, that's essentially one notch down from where it was this time last year, and that's just a direct reflection of the change in MID and the fact that a stated successor has not been made. And so that's, again, just uncertainty, which we would expect to dissipate over time as that team gels and we get a better sense that the process, which has generated the excellent results that we've seen over the last number of years, remains in place. And that's something we're in constant contact with the team to understand what they're doing in the portfolio. I think they provided an outstanding overview on that point here so far. Now, when you look at some of the other scores, I think the broad takeaway is that they're outstanding, quite frankly. When you look at the information gathering and forecasting, both of them are rated as A's, which is right there at the top, given the strength of the team and the depth of resources that they're able to bring to bear. All of that is reflected here. And when you think about the process that they go through for constructing a portfolio, all of those rank very highly. And so at the end of the day, we have a weight for each of those scores, and that's what rolls up to that overall score for a B. So I certainly wanted to use my opportunity here to correct some of the misinformation that was out there from earlier this week. I'm going to stop there because we think the staff has done an excellent job walking through the portfolio, but I'd be happy to answer any questions on the methodology or any specific scores that you may have.
Yes, there are no questions, but I just want to thank you, Tom, for expanding on that D letter, because you're so correct in that sometimes the general viewpoint is that they take one little piece of information and they want to span that over the entire organization, and that was the fake news, as you made reference to, that I saw this morning also. So I'm glad you were able to expand on that and identify what a narrow implication of that D is, as opposed to that story that is the entire organization. So
Right.
appreciate that. Okay, before we move to 7C, were you complete? You finished? Okay. Before we move to item 7C, I forgot to welcome Ms. Jenkins Jones to her first investment committee meeting, the representative from CalHR. So welcome, Ms. Jenkins Jones. I forgot to do that. Okay, now we move to item 7C, Real Assets Annual Program Review.
And while we're waiting for the real assets team to come up, I just want to underscore, the incredible talent that we have within the investment office, I think, in the fixed income team, and then now as we see the real assets team combining, and we need to value that, especially any time that we see a headline like that, it goes to, in the fixed income team's perspective, professionals that have worked here 20, 30, 40 years of their careers to build this incredible success. I do think it's fair, as Wilshire mentioned in their comments, for them to grade those components the way they have pursuant to methodology. Of course, you want to signal to the committee and elsewhere when there's transitions going on, pay attention. And I just want to assure you, we're all paying attention on the transition, and we fully expect to have these positions filled. You had the announcement on the CIO. I would expect we'd be able to fill these MID positions by the end of the year, so that at the beginning of the year you'll have a full team on the playing field in a sequence that makes sense for us. The one area that we won't be able to address in the Wilshire scoring is on compensation and ownership. We've always received basically a C grade on that, because, as Wilshire notes, we're not able to offer ownership or equity compensation for our team that you would see at a PIMCO or a asset management firm. So we're always going to hit a ceiling in terms of the equity ownership and the overall level of compensation that we offer to these great teams. We're always going to have a ceiling of a rather middling grade. So with that, I see the team is here now, but I wanted to just emphasize those points while we were waiting for Paul and his team to get here.
Okay, thank you.
Good morning, Investment Committee. It's a pleasure to present the annual program review for real assets. I'm Paul Muchaka, CalPERS staff, and I'm joined by 3 members of the team: Jane Delfendahl, Mike Inglett, and Ed Urey. I wish to emphasize, however, that the prepared report was a total team effort. Last year, we discussed the strategic position of the real assets program. Staff continues to strengthen the position of the portfolio, but it is a portfolio still in transition. There has been more than $24 billion of investment activity in the program over the last 3 years, stemming from the acquisition of long-term strategic assets and the disposition of non-strategic assets. What has guided staff has been the investment beliefs, the role of real assets prescribed from the ALM, the strategic plan for real assets, and ESG integration. But the main ingredients born from those 4 cornerstones are not as tangible. They are the intangibles and the behaviors of consistency and methodical adaptation. So what does that actually mean? One example of consistency heard by the board regularly has been to grow our core exposures in a measured and disciplined way. This has resulted in 12.5% returns for real estate and over 17% returns for infrastructure over the last 5 years in the core category. Another area of consistency has been to expand execution through our separate accounts and direct ownership, which now stands at 90% of the program. This has resulted in significant cost savings, investment belief number 8. But we also need to adapt to changing market conditions. Examples where we have adapted is through the introduction of the Emerging Manager Program, we have invested over $900 million and achieved 15% returns for the last 5 years. Another area of adaptation has been to invest in energy optimization in our buildings. This is done to improve returns, lower our operating costs, and lower our energy usage. Balancing between staying the course and being steady and adapting is key to our success. Real Assets has maintained discipline around vintage year management. We all know timing is a very important part of investing. As a long-term investor, investment belief number 2, it's our responsibility to do so, as it will benefit the fund in the long run. The team will now take you through where we have been and where we are going. Jane Delfendahl will discuss our performance and our report card to our role, which we have presented for the last 2 years. Mike Inglet will discuss our portfolio position, and then Ed Uri will discuss our current initiatives and our accomplishments. Thank you. Jane?
Thank you, Paul. Good morning, Investment Committee members.
Good morning.
I'm Jane Delfendahl, Investment Director. I will talk about the performance of real assets, which can be found on page 2 of your program review. For fiscal year 2017-18, the real assets total performance exceeded the benchmark. Given the illiquid nature of private real assets, however, more emphasis is placed on longer-term performance. For the 5-year period ended, real assets underperformed the benchmark by 20 basis points. The 5-year real assets underperformance resulted primarily from forest land assets and secondarily from non-core real estate assets. What really powered our performance is our core holdings in real estate and infrastructure. Core real estate exceeded the benchmark by approximately 200 basis points, and core infrastructure exceeded the benchmark by nearly 1,200 basis points. It can be noted that since the Real Assets Strategic Plan of 2011, the real assets role shifted to a greater emphasis on core and income-producing holdings. Further, the real assets performance for the 1, 3, and 5 years exceeded the 2013 ALM expected return of 7%, as referenced in the box on page 2. Moving to page 3 of the report, this is our report card with respect to our role. It shows how the real assets portfolio is increasingly meeting our role of real assets, which entails 3 pillars. These are stable cash yield, partial inflation protection, and diversification of equity risk. The improvement of alignment with our role is evidenced by our production of more stable, positive income in a falling yield environment. Note our income has stabilized and greatly improved and sits at 3.5%. This shift has been through acquisition and growth of our core portfolio and through the methodical disposition of our non-core portfolio, which was largely acquired in the latter part of the last business cycle. The hard work that has been put into place since the end of the global financial crisis has had a cumulative effect, bringing us to the position of strength we're in today, allowing us to be adaptable to changing market conditions. Now I'll pass it off to Mike Inglet, who will discuss the portfolio positioning of the real assets portfolio. Mike?
Thanks, Jane, and good morning, members of the board. My name is Mike Inglet. I'm an investment director in the Real Assets Unit. I will discuss with you the real assets portfolio positions on page 4 of the annual program review. Over the past several years, we have made significant progress in repositioning the portfolio. All the efforts made by the team were guided by the investment's beliefs, the real assets role, and the strategic plan. These moves resulted in a higher quality and lower complexity portfolio. Starting with higher quality. Over the past 3 years, the real assets core portfolio percentage has increased from 46 to 78%. During that same period, portfolio value growth in real assets core exposure has increased by approximately $15.5 billion. At the same time, the non-core exposure was reduced by approximately $8.5 billion. In the context of a private, illiquid asset class, this is significant, as there was a total shift of approximately $24 billion of equity. Further validating the shift over the past 3-year period, core investments have outperformed non-core investments by approximately 3 times, with returns of 9% and 3% respectively. Shifting gears to lower complexity in the portfolio over the last 3 years, first, real assets has continued to maintain discipline in using leverage. The LTV has remained around 33%, which is well under the policy limit. Second, the percentage of assets under management in separate accounts has increased from 80% to 90%. Third, one of the goals of Vision 2020 is to reduce complexity by lowering the number of external investment managers. Real assets has significantly reduced the number of managers from 58 to 30 in that period. This has allowed for improved oversight from staff and strengthened strategic relationships with our partners. The lower complexity items mentioned have led to stronger governance, better control, and reduced fees. In summary, the result is that through these efforts, we have contributed to strengthening the portfolio position and increasing alignment with the role of real assets. I'm going to pass it over to Ed Uri to cover accomplishments and initiatives.
Thank you, Mike. Good morning, members of the board. Ed Uri, Investment Director. My discussion points center around pages 5 and 6, fiscal year 17-18 accomplishments and current year initiatives, highlighting where staff demonstrates consistency and adaptability. As Paul touched upon earlier, our program's achievements have been and continue to be driven by these 2 key ingredients. We have been deliberate in our approach as we implement our strategic plan and build a stronger portfolio in a disciplined manner. I will now highlight a few key examples covered on pages 5 and 6, where staff has exhibited consistency and adaptability. On page 5, we identify accomplishments across varied categories. A few noted examples that point to staying the course in implementing our strategic plan are as follows. Number 1, completion of 3 segment plans providing guideposts for portfolio construction. Number 2, continued focus on increasing our core exposure in both real estate and infrastructure. For example, the infrastructure portfolio has doubled in size over the past 3 years. And number 3, achieving significant fee savings through contract renegotiations utilizing our preferred alignment model. In terms of adaptive accomplishments, examples include staff's inclusion of energy optimization into our annual investment planning process, the rollout of an ESG consideration matrix for underwriting new investment opportunities. Another is adapting our emerging manager program through expanded guidelines and additional capital commitments. And further, establishing a defined focus for the launch of the transition manager program based on portfolio needs. Moving to page 6, several initiatives that further highlight consistency include staff completing its segment planning process. Also, expanding our preferred business model in infrastructure to facilitate an active pipeline. Additionally, the team is piloting its energy optimization plan utilizing a systematic approach across real estate in identifying economically attractive opportunities. Continuing with page 6, examples of adaptive initiatives include 1, strengthening our investment process to be responsive to changing conditions such as climate risk. 2, restructuring the forest land portfolio, improving governance as well as alignment. 3, evaluating our retail portfolio and its underlying strategies. 4, launching a search for the transition manager program. In summary, the adaptive components of our program become an ingredient to our consistent and deliberate approach. These are the common threads as we strive to be disciplined and incremental in building a stronger portfolio. At this time, I would like to pass it back to Paul. Thank you very much.
Thank you, Ed. We hope that this presentation has illuminated the strategic position of the real assets portfolio. We are 9 years into a positive market cycle. We cannot predict the exact timing of the next downturn, but staff firmly believes that you cannot take the cycles out of investing in private real asset markets. Equity markets have risen, and core returns have significantly been lowered. It's in these times that there's a tendency to do 4 things. Increase deployment to catch up to the allocation, go up the risk curve to try to attain higher returns, shorten due diligence periods to close more deals, and 4th, reduce your focus on governance. Engaging in these behaviors will impair the alignment of real assets with its role and the investment beliefs. Instead, it is even more critical for CalPERS within the real assets group to focus on paced deployment, strong governance, and sound internal controls and systems to underwrite, manage, and monitor the portfolio. These activities, honestly, are not eye-catching, and results do not show up instantly. But this approach will allow us to maintain consistency and adapt to changing market conditions into and through the next cycle. With that, we are happy to have a discussion with the investment committee and answer questions. Thank you.
Ms. Mather?
Thank you, Mr. Chair. Well, thank you so much for this review. You know, you said it right there in your closing, Paul, that just how important maintaining a methodical, thoughtful, consistent, diligent approach to investing is essential to driving long-term returns. We've seen what happens when shortcuts are taken, and that might not bear out immediately, but certainly will come home to roost in the future. So essential that the team is continuing to focus on that. We have talked before about infrastructure and how do we improve the pipeline. I'm glad to see that there are some efforts underway to sort of push out our preferred model. Would love to hear a little bit more about that, and also just share with you that I've recently had a conversation with Kevin Ubelein, the CEO of AIMCO, the Alberta Investment Management Company, and they've been doing some engagement work with developing countries around what does it take to be investable, to have an infrastructure project that could be investable by an entity like an institutional investor like AIMCO. And just curious whether we've participated in any of those conversations, or if we would, and whether we think that would be fruitful.
On the first part, Ms. Mather, on your comment regarding the pipeline, we'd be happy to get to discuss that in closed session. We have a fairly active pipeline today that the staff is working on. On the second point, I see Elizabeth reaching for the microphone, so I'll let her go.
Sure, absolutely. Thank you. Thank you very much for your point about infrastructure and how to bring sustainable infrastructure forward as well in our portfolio. We are participating and very proud and happy to participate to a very exciting initiative, which is the G7 initiative, together with some Canadian plans and some European plans. And this initiative has different parts, some of them on climate change and diversity, as well as job description of the future, and also one particular initiative on sustainable infrastructure. So it's really about bringing first of all, on the emerging market side, a certain kind of guidelines and rules in order to be able to efficiently work on those markets in terms of infrastructure. It's also about sharing experience, both on the deals and also on the due diligence and the risk-taking about those infrastructure projects. So we are very happy to participate to those very, I would say, very exciting and very innovative approach that was taken as part of this G7 initiative. So more to follow on that, because we have just started, and we'll be able to update you together with our team on infrastructure.
Thank you.
I will just add one more thing in addition to that. We have responded to surveys that have been put on by various emerging market. One in particular was about Africa, where we worked with a group, NASP, I believe is the name, to provide our feedback, both from an experience perspective and from a strategic investment perspective, on what would be an investable project and what tenets we would look for in terms of governance and returns, et cetera.
Thank you very much.
Ms. Taylor?
Yes, thank you. Thank you, Paul. That was a really good presentation, and I appreciate your closing statement, because throughout the review, I was reading that we were, equity markets had risen and our returns are going to go down, and I was a little concerned that maybe we were looking at doing what put us in trouble in 2008 and getting, a little bit, well, maybe we need better returns, so we're going to do those mortgage-backed securities again. So I'm glad to hear that you guys are staying the course and working on our core returns, regardless of whether they are declining, and just staying in that position. And then I had a question on the improving the pipeline for the infrastructure. I just wanted you to, and I know Ms. Mather talked about it a little bit, but I wanted you to kind of elaborate on that a little bit for us, and how this came about and how you're working it.
So in terms of specifics, we'll go through, we're happy to discuss that, what the active items are today. I want to add just a few comments. So first, we have built the largest infrastructure portfolio of any U.S. public plan, at close to $4.25 billion. There's a high degree of scarcity of infrastructure investments that match our role today, and they tend to be highly competed. And the transactions are, for lack of a technical term, just lumpy. They're big, they're airports or a port or a toll road. So they come at you in a very episodic, big, chunky way. We have really been working hard to establish a repeatable business model where we can, operate in a more consistent way, knowing full well that the transaction markets we have little or no control over, and they will remain lumpy, at least for the foreseeable future. I will add a few more points, which is we have 3 investment managers in the new investments team, and they spend almost, and their support staff underneath them, spend the majority, if not all of their time, working on these various projects and the pipeline, which again we'll discuss. But the strong returns that we've achieved are high. There's a high degree of dispersion in those returns, which Makita points out very well in their letter. And that dispersion, from our perspective, means that being selective in the portfolio construction is very critical. So we have to balance creating that repeatability, but also remaining selective.
Thank you very much.
Ms. Yee?
Excuse me. Thank you, Mr. Chairman. I just want to thank you and your team, Paul. This is a very, very impressive degree of work, and the performance is obviously showing. And I wanted to just ask you a question with respect to something on slide 6, and it had to do with the savings realized from the alignment model, and whether you anticipate any additional savings from
Page 5?
I'm sorry, 5.
So we showed up through this fiscal year because we are aware of the actual returns that have happened.
Right.
It's hard to anticipate the future without knowing what returns come from our portfolio, because the component where we've really reduced our fees are both on the asset management fee, but also in the, quote, profit sharing payments that we've restructured. So it's hard to forecast exactly the amount going forward. I will say that a lot of the low-hanging fruit, like in most situations, has been squeezed out. We don't anticipate that the fee savings will mirror what has happened in the last 3 years, but we do anticipate, depending on returns, that we can find other opportunities to expand our model, as I mentioned before.
Right.
But it does stand at 90% of the program today. Around the global financial crisis, that number was significantly lower than where it stands today. So that's where a lot of those fee savings were born from.
Gotcha. Okay, great. Thank you. And then I wonder if you could just make a brief mention about, I know the retail study is in progress. Any initial insights at this point?
It is early on that, so there's more work to do. You know, retail is a very fickle animal. It's always evolving, and we focus, and it's something that PCA has highlighted consistently for a number of years with the board. We focus on having a dominant retail strategy, keeping that evolution and in mind, and that fickleness, if you will, in mind. We also have our annual investment plan. So with our annual investment plan, our partners, whether they're retail, office, multifamily, they come in and see us at least once a year and go over the portfolio. We discuss the needs in our existing portfolio and the opportunities going forward. With our partners active in the market day to day, they give us real-time information in terms of where to tilt the portfolio and where not to. And they're incentivized to provide that information through their profit-sharing payments and whatnot. As we look ahead, we are in the midst of doing a fairly robust review, and our focus is to always improve the quality of our retail portfolio. And if there's any opportunities for us to do that, that's really the underlying current and focus in our retail review today.
Thank you.
Okay, Ms. Brown.
Thank you. Early in the presentation, you talked about disposition of non-core assets. So can you just explain that to me in layman's terms? Is that like selling things, and what is non-core versus core? Thank you.
Non-strategic assets. Some non-core assets we own are strategic, but an example of some of the sales that we've executed. First, we had a very large commingled fund, opportunistic commingled fund program. It was north of $3 billion. We have disposed of that very large, complex portfolio, very high fees, and was a drag on our performance for a number of years. We also recently disposed of a timberland holding that was tied up with very onerous leverage and difficult supply agreements that had some unique circumstances in our structure. So these are a couple of examples. And the underlying current, as I mentioned to Ms. Yee on retail, is focusing on properties and infrastructure projects that align with the role, and that role being stable cash flow, diversification of equity risk, and inflation protection. So in terms of how we cull our portfolio, it really has that in mind.
Great, and I know we talked at great detail about the timberland sale. So would I find the other dispositions in some of the charts or details we get maybe in closed session? Is that where I would find them, or are they listed anywhere?
Some are. Some are done just through natural attrition from our core partners. The more significant ones, such as the Timberland one and the commingled funds that I highlighted, these would be found in reports that go to the board.
Great.
But in our annual investment plan, one of the other features that comes up, as I mentioned earlier, when our partners come and they don't just say, this year we see an opportunity pipeline of X million dollars for us to pursue, they also give us information about our portfolio and may say, there are 4 properties that we believe are the right time to exit from and cash out. They no longer will be, they're no longer positioned to be aligned with the role and what you're looking to achieve.
Great, and so those dispositions totaled about $8.5 billion, is that what I heard?
The dispositions are probably not the full $8.5 billion, because what we've included in that is the change in value of the portfolio.
Oh, okay.
But it is the lion's share.
Great, thank you.
You're welcome.
Okay, thank you. So I see no further questions for staff. And before we go to item 7D, we have a request to speak on 7C. Mr. Michael Ring, if you can come up, you will have 3 minutes. And take your seat here at my left end of the dais. And the clock is right below me here, and you know the drill.
Know the drill. Good morning, Chairman Jones, committee members. Michael Ring, Service Employees International Union. Just a brief comment that I think your staff is not taking as much credit as they should for one component of particularly your real estate portfolio, which is that CalPERS has a long-standing responsible contractor policy. And as someone who represents members on both sides of your equation, members in the system and members in the real estate markets who provide janitorial and security contracting services, I think CalPERS is a great advantage compared to many other institutional investors we work with, because the responsible contractor policy is baked into your process from the beginning. I don't have to share with this committee how many issues you mitigate and risks you mitigate from worker, community, or tenant concerns that your partners and your own staff have much greater control over and an ability to ensure a positive outcome by having it on the front end, and everyone's considering this from the very beginning. It's very difficult for investors when they find out on the back end that the quality and value at the building is being threatened because someone is being sexually harassed, someone is not being paid, someone is not providing the services that they were contracted for. So I just wanted to emphasize how important this committee's work has been in having this policy and how great it's been to work with your staff in implementing the policy across the years. Thank you.
Okay, thank you very much, and we appreciate you coming here to share your comments with us today, Mr. Ring. Now we will go to 7D, the consultants review. We have Wilshire Associates, Pension Consultant Alliance, and Makita. Who's going first?
Which
Wilshire?
order would you like for it to go?
Wilshire, you go first.
All right. That's good, because I think mine may be the shortest. So we've provided an opinion letter and no additional slides, but we make comments both as the general consultant on the overall real assets program and then as the forest land consultant. So I'll phrase my comments in those two directions. Overall, we believe that the real assets program is being run in exactly the way that you want from a strategic standpoint. It's focused on cash flows. It's focused on inflation sensitivity, whether that's real estate or infrastructure.
Pull the mic towards.
Whether that's real estate or infrastructure, or at this point, forest land with the changes in the portfolio there. So from a very high level standpoint, we're pleased with how the real assets program is going. If you look on page 2 of 6, 224 of mine, you can see the top chart is rolling correlation with the growth assets of CalPERS, or the income portfolio of CalPERS. This is supposed to be a diversifier. You can see more recently it has been. There's that spike at the beginning, which it's fair to say is a crisis, and during a crisis, all assets tend to correlate towards one. So That's not to say that if there was another crisis now, we wouldn't see the same kind of spike. I think it would be lessened by the changes that you've made predominantly in the real estate portfolio over the last decade. Moving on to the forest land portfolio, there are a few graphs in here about timber prices. We've covered this, I think, pretty extensively over the last couple of meetings, so I'm not going to spend a lot of time here. You had a portfolio up until the sale of Crown Pine that was really focused primarily on southeastern timber. If you look at the prices and you sort of step back a little bit and try to discern a pattern, you can see southeastern timber was probably flat at best. Northeastern was probably trending up a little bit, and then Northwestern was up pretty significantly, and so that was a headwind that the portfolio faced. The sale of Crown Pine has really changed the structure of the forest land portfolio. First off, it's not nearly as big. Second, the debt issues that plagued Crown Pine have been removed from the portfolio. There's essentially zero debt at this point on the portfolio, and so staff now has plenty of time to make decisions about whether or not the remaining assets should be retained, should be sold at some point in the future, given the changes in the overall benchmark for real assets, which it now has a real estate only benchmark, meaning infrastructure and forest land essentially have to compete with real estate. It could be the case that staff decides these remaining timber assets are competitive and should remain, or they may decide it's not an important strategic part of the ongoing part of the real assets program. So I'll stop there. That's a pretty high-level review of our written comments. Happy to take any questions.
Okay, seeing no questions on that item, we go now to PCA.
Good morning. Christy Fields, PCA Real Estate. I was actually happy to hear Paul's closing comments describe real estate as not eye-catching. I'm really happy to be not eye-catching at this point. I think staff has done a great job of describing the program over the last year and over the last 10 years, really. And I was just here with my colleague David last month speaking about the performance, so I won't spend a whole lot of time on that. I would like to just reiterate the point about the focus of the program being on core portfolio, core properties, and those being really high-quality, income-producing assets in durable locations. And you can see the results of those. If you look particularly at the 5-year in the top table, these are returns for the different risk subsectors in the portfolio, and you can see the very strong performance of the core program. The bottom table peels back the onion just a little bit more in that it focuses on the income returns. And you can see that overall the program generated an income return in line with the benchmark, but that the core portfolios produced an even stronger income return. And as Ted mentioned in his earlier opening comments, that is one of the main objectives of the program. So delivering strongly on those objectives. I wanted to touch, as most people do, on the investment beliefs, but just to acknowledge what a strong tool this has been for the system in whole, but for the real assets program specifically. It's been very deeply and well integrated into the investment decision-making process, and is a strong, it's one of the strengths that I mentioned later in the SWOT analysis as a really kind of guiding light for the whole program, along with the very specific role of the program. I don't have my buddy Sarah Bernstein here, who's our ESG expert, so I'll do my best, but I did want to highlight all the many ways, some more nascent than others, that the program is really beginning to integrate all these ESG objectives into decision-making and portfolio management efforts. CalPERS continues to be a leader in U.S. institutional ESG efforts, and it's as we've mentioned before, real estate is one of the asset classes with the strongest reasons for and the most benefits to gain from these ESG integration efforts. you're particularly advantaged by your business model, which through which you invest in a smaller number of separate account structures over which you have control, in comparison to others and investors who are not able to use separate accounts to the extent that you do, and have to gain most of their real estate exposure through closed and commingled funds over which they do not have as much control. And this has allowed you really to continue your leadership efforts in the ESG area. I'm going to skip a little bit ahead so I don't take up too much time to the SWOT analysis on page 9 of our deck. You'll notice if you read through these that some of the attributes are both, can be seen both in a positive and then in a less positive way. Scale is kind of an obvious one, and we've talked about that before, but it really gives you the ability to pursue the business model that you do. And it also gives you, the size of your portfolio gives you tremendous market insight, just given the number and the breadth, the geographic distribution of your portfolio. Scale, on the other hand, can be a challenge when you're trying to be innovative. And I think Paul's discussion of pursuing innovation in small and targeted and disciplined ways is the right response. Also among strengths, I think, in addition to the strong purpose and board direction, really, again, is an incredibly talented and diverse team under a very steady hand with the MID, very disciplined, and the culture of the team is very positive and collaborative, and I think really inures to the benefit of the system. I think on weaknesses here, the other one I'd like to highlight is, and some of these are not necessarily specific to CalPERS, but rather to market conditions currently. But when I was here in August, we talked a bit about the opportunities present in your existing portfolio to deploy capital to either add additional space or to improve the quality of the assets and to increase your revenues generated by those assets. The costs of maintaining and improving those assets are increasing, so some of the returns on that, the deployment of that capital may not be as large as they might have been in the past, but that's not just impacting CalPERS, that's impacting all real estate investors. On the opportunity side, again, your business model and your strategic partners offer a tremendous opportunity in that they have very deep footings in their individual sectors and can do a lot of working of the individual assets at the operational level to improve the net operating income and the profitability. And in this market where acquiring assets is so competitive and so fully priced, being able to do that is a specific benefit to CalPERS. Amongst the threats, we put organizational change on there, I think, just to recognize that there's been, over the past 12 to 18 months, a fair amount of change at senior leadership positions. It looks like the system is addressing that well. Very excited to hear about Ben, by the way. And then one of the other threats, and I think the fixed income program review touched on it also, is just the pace of change, technology, and some of the disruptive forces that are impacting real estate, as well as many of the other industries. And on the next page, these are just a few of these. And I think staff is spending an appropriate amount of time continuing to study these and research these and review their portfolio holdings in light of the way that these dynamics are influencing the way people interact with real estate, and making sure that you have a very high quality portfolio today and in the future. I think I'll stop there.
Okay, we have a couple questions. Ms. Taylor?
Yes, thank you. Thank you for a really comprehensive review. And had I really thank you very much also, and Sarah, who's not here, for the ESG assessment. And it was very comprehensive, so thank you very much. But also, I had a couple of questions. One, under threats, you have, I can speak English, proliferation of new bank lenders, new non-bank lenders, and less regulation. So, and then higher leverage and more speculative supply are historic harbingers of real estate downturn. So for the first one, I don't understand the new non-bank lenders. And then the second one, if you could explain for us.
Certainly. So non-bank lenders include life insurance companies, the commercial mortgage-backed security market, and a lot of the debt funds that have proliferated recently. And we put this in here back in 2007, in advance of the global financial crisis. Really, real estate lending was all about the banks. And today, non-bank lenders have made big inroads into commercial real estate debt markets. And so roughly, the real estate lending market is now roughly equally divided amongst banks, life cos, the CMBS market, and then the debt funds. And so there is now a significant portion of that market that's not regulated as the banks are. And so generally, leverage is still quite moderate compared to the last cycle. That said, we're seeing kind of anecdotal evidence of some loosening of covenants and some easier lending in the non-bank space. And so that's just something that we're continuing to monitor since it was a significant part of the dislocation in the last cycle.
So you're monitoring it to make sure that we don't end up in the same place and losing money, not necessarily because they have direct impact to CalPERS.
That's absolutely right. And of course, you are in a much less levered position than you were then, and just your investment strategy, it does not emphasize leverage the way some other investors do. So, yep, there would be less of an impact.
Well, yeah, it'd be nice to make sure we do monitor that to make sure we kind of have a heads up if something like that were to occur again. And then the higher, so is that what you were talking about, the higher leverage, more speculative supply as well?
Yes, those are, supply, real estate gets really dislocated when there's excessive supply added and then when there's additional leverage. And so we've seen certain markets with certain property types where there has been quite a bit of new supply delivered, multifamily markets and some office markets. And again, it's nothing like we saw in the last cycle, but we're very late. They were long in the tooth in this one, and we're just starting to see some of these dynamics a little bit, and just keeping an eye on it. So if this is not really a red flag right now, but they're classic real estate disruptors, and so things that we again monitoring.
Thank you. I do appreciate that. And then I also just wanted to kind of reiterate what Mr. Ring had said earlier. Our responsible contractor program has been very successful. I hear a lot about it when I go out to events, and so the fact that you guys are helping us with that, I do appreciate. I'm also very impressed over the rest of your sustainable investment in the real estate market, and I mean, it's just important we think about what properties we own and where we own them and how much impact that may have in the future for flooding problems, or, I mean, from what I understand, Miami is constantly underwater at this point. So I think it's very important that you guys covered this under this portfolio. So I do appreciate that. And then I had one more question. Okay. As you technology changes, space use disruption, and innovation are influencing commercial real estate. So what's biophilic design?
It is a design that emphasizes the human need for connection with nature, and for those connections and how they feed us and support our productivity. And so it includes, it's a very all-encompassing type of thought around design, but it includes the use of natural materials, of natural light, of shapes that are found more universally in nature, spheres and other types of shapes. And it's really becoming an interesting, and I think it's going to be an important movement in the way new real estate assets are designed and integrated into our cities.
Okay, thank you.
Yep.
And while you're on that page, what's the gig economy?
The gig economy basically refers to a labor market that is more characterized by short-term or contract-type employment rather than permanent employment.
Like Ubers?
Ubers, yeah.
Okay,
exactly.
thank you. Okay, Ms. Marther.
Thank you. In your overview of the SWOT analysis, which is on page 9, the way I heard you talk about innovation was as a strength, that we are implementing small, demonstrable, innovative techniques, but the way you've listed it is as a weakness, and I'm just curious what you meant by innovation as a weakness.
Yeah, I mean, I think you are doing some interesting things in the Emerging Manager Program, in the ESG integration, but it's difficult to do a lot of it, and it's difficult, I think, also, and innovation also applies to, I think, investment strategy. And so it's difficult for you to move into sectors that are simply, you can't put $2 or $5 billion in. Some of these nichier sectors that have been very popular in the last 4 or 5 years and have been throwing off strong returns. It's more difficult for you to access those types of properties. So I agree that where Paul and his team have picked and choose to apply their energies and to try and do some things new for the system, it's tougher. It's just tougher.
So is that more, so that's related then really to scale, which is the first. Okay, thank you, that's helpful.
Mr. Slayton.
Thank you, Mr. Chair. Coming back to page 10, the chart, the biophilic design. So, that's an opportunity for future projects, but what is its impact on the current projects that did not take that into account? And what do you see as the impact on our existing portfolio?
And I think that's exactly why I put it on here, because it's new, and I think staff is really, given how large your portfolio is, their energies are spent on deploying new capital, but also a lot of their energy is spent on management of the existing portfolio. And really what they do and what they have developed a good discipline around is doing their best to see around the corner and what's coming, and adjusting their portfolio either through new acquisitions or through dispositions or renovation to be aware of these things that are coming, because the younger generations of millennial, we talk about them all the time, really interact with the built environment in a different way than we did. And so I think this is just one of those things out there that I think is going to become a much more prominent piece of new design, and so important to have on everybody's radar.
Okay. And then two of the other pieces of the chart are artificial intelligence and machine learning. Could you help me understand the difference between those two things?
Yeah. I'm going to cheat with my notes because I didn't see. So artificial intelligence is actually kind of the theory and development of computer science that allows machines to do things that have traditionally required human intelligence. And so kind of easy ones are speech recognition and those type of things. And you're seeing that a lot. Kind of the easiest applications to real estate are smart building management systems with all the sensors and the monitoring. The machine learning is interesting, and it's really just becoming important to real estate, primarily because real estate's always been a very fragmented industry, but also because as real estate practitioners, we're all a little bit, there's a certain amount of inertia to the adoption of data, right? I mean, real estate used to be who could have the secret, the best secret, the longest, right? To get your building developed before somebody else's did, or get your lease signed. And everything, that's all changing. And so machine learning now is where they are using real estate data to improve investment decision making. So they're actually creating machines that they feed giant data sets to that then learn from the data without being explicitly programmed. And the way that's getting applied to real estate is kind of predictive forecasting. What will returns in the multifamily space in Sacramento look like in a year or 3 years or 5 years? And so it's really fundamentally changing the way people are investing in real estate. But it's fairly new.
Interesting. Okay, thank you.
Okay, yeah, Mr. Eliopoulos.
Just use this as a opportunity for a commercial sort of plug and announcement for our Pillar 3 in our private equity plan. One of the driving forces and factors there is to access these technology companies that will be extreme disruptors across different sectors, including real estate. Because I think what the essence of Mr. Slayton's question is, yes, our current portfolio is vulnerable to that level of disruption to the extent that we're not innovating and changing along the way. So one, having a portfolio with access to that sort of knowledge and data around the technology disruption that is coming is important for the return stream that it will bring to us potentially, but it's also important to us for the information that we'll receive and the data that we'll receive from the Pillar 3 portion of our portfolio to use it to infuse into our real estate portfolio in this case, so that we can assess the level of change and the pace of change and protect ourselves on one side of the portfolio and take advantage on the other side.
Thank you. Ms. Yee?
Thank you, Mr. Chairman. Ted, your question or your comment just triggered something in my mind. Maybe it's a question for Makita, and it has to do with fees and whether you believe there's greater transparency between the infrastructure GPs and LPs relative to fees than there's typically in private equity funds.
He hasn't made it.
I can just start and then turn it, maybe segue over to Makita for sure. We definitely have better transparency. Well, I don't want to say better transparency. The fee approach in our separate accounts is very simple and very straightforward and something that we can monitor quite explicitly. And with fewer partnerships, there are things that we can do in real time. The private equity fee structure in these commingled funds, as we've discussed, have all these different fees associated with it. So it's more complex, and to the extent that we have hundreds and hundreds of partners, it's more cumbersome and time-consuming to evaluate the fees on a real-time basis. So for CalPERS experience, that's the main difference in terms of what differences there are in the infrastructure market or private equity market or real estate market. You're right, that's a better question for Makita.
Steve McCourt, Makita Investment Group.
Excuse me, maybe Ms. Yee will have him make his presentation because he's going to talk about. Yeah, he hasn't presented yet.
Okay, I'm sorry.
So, but before we do that, why don't we take a 10-minute break and reconvene at 11:25? Okay.